Welcome everyone to episode number 20 of the Widelands podcast.
Who would have thought, right? Hey.
And
Thank you.
We got that one right. I've got Matt Rigby here. We're going to cover the latest topics in financial and investing markets. We're recording this on Friday, the 10th of June, and we'll get straight into Matt's Market Minute.
Yep, here we go. So the Aussie for the week. Now, this is up until Thursday's close, down about 2.25%. For the year, just under 8% down. Today is not going to be great. We'll get into that in a second. So for the week, I've got an acronym there, and I don't even know who it is. But so there's a couple. Atlas Arteria, which is an infrastructure, basically a toll road company. They're up 12 odd %. IFM Infrastructure have taken a 15% stake. And expectations are that there will be a full takeover at some point. The Shaver Shop.
How are they going?
Bit random, but they're up about 5.4, 5.5%.
People are shaving off their beards. I've still got mine.
Is that the new trend with turtlenecks? People are. So they came out with positive profit update. Like-for-like sales up 28% from pre-COVID. So not 2020, but from 2019. So that's really strong. Maybe it is that. I don't know. But they had some pretty positive comments. So the market liked that. Uranium stocks caught a bid. Biden was announcing a $4.3 billion effort to reduce reliance on Russian uranium. So Peninsula Energy up about 7.5, Paladin up about 1.3. The banks took a hit after the RBA did their thing. CBA down 10% for the week.
Hold on, isn't the rate rise is supposed to be good for banks? They pass on the margins.
Yeah. So the thinking. So a couple of brokers came out with reports saying, yeah, the margins will increase and that's good, but the cost pressures are going to erode all of that.
And did these cost pressures miraculously appear this week, did they?
Just at the same time that the RBA raised rates. It was just coincidence.
Okay.
Maybe overdone there. So the NAB down 10%, Westpac 12, ANZ, the outperformer, down about 7. And Audinate, the audio-visual networking company, up about 2.7 after upgrading earnings. So that was good. Little Aussie company doing well internationally. The NASDAQ down about 3%. Most of that was last night. I was thinking 2.2% last night. Year to date down 25, getting up to 26%. The S&P down just under 3% for the week, 16.25 for the year. Around 140 positive for the year. Something in the order of 290, 300 down more than 10% for the year. Earnings are really starting to trail off. Just a couple of interesting ones. Dave and Buster's. So that's like the pub entertainment group. They're up about 6% after an earnings beat. Campbell's Soup coming into winter up 2.6%. They beat
and a recession.
Well, cheap. It's like soup and pasta and a recession. Totally. And Five Below, which is the discount retailer over in the States, up about 4%. One for you, Rob. DocuSign came out with earnings after the market getting belted and then belted again, down about 20% after market and down about 20% for the week. Another one for you, mate.
I saw that in the doc.
So Roku, earlier this week, there was rumors internally within Roku's head office that Netflix are about to make a bid. And now why this is interesting.
Netflix has got no money. How are they going to make a bid?
Stock, probably. I don't know that as a Roku shareholder, I want Netflix stock, but whatever. So Netflix actually started Roku and spun it out into its own business because they didn't want to get into the hardware side. What Roku do really well is that ad-enabled streaming, which Netflix are looking to get into. Anyway, Netflix was up 3% on the day that this came out, and Roku was up about 12. So that's interesting.
So what do you now
maybe
down net?
Now I'm only down like 45%, so that's good. Chinese stocks the communist government there approved new games for the first time in a few years. So some big moves there in some of the Chinese tech companies.
Yeah,
Alibaba,
massive move. Yeah.
Yeah, Alibaba up 15%, JD7, Baidu 1, and iQIYI, which is the kind of Netflix-ish equivalent, up about 8%. Interestingly, I also saw the Ant Financial's IPO might be back on.
Yeah, saw that. Just to throw something in there, just having a look at the BetaShares Asian Technology Tigers ETF, up about 15% over that time as well.
Hey, right.
Yeah.
Okay. Yep. So pretty strong. If you happen to be in it, you're probably still down a lot. Target down about 3%. We'll touch on that later. Not great news there. Facebook is now trading as Meta. That's their ticker. So they've gone from FB to META. They're down about 6% for the week. And Amazon had a 20-for-1 split.
Yeah.
So they're down about 80%, but not really. Emerging markets down about 0.5% for the week, down to about 12% for the year. Oil up about 2%, now up 61.5% for the year, $121 a barrel. Diesel is now cheaper than petrol.
Saw that.
So did I. And Bitcoin up about 0.7 for the week, down 37% for the year, $30,065 a coin.
Doing better than Target, down 46%.
Yes. Yeah.
Thought I'd throw that in there.
Nice one.
All right, let's get into the first topic. We're on you.
So US mortgage activity falling off a cliff. So this is something that we've kind of touched on a few times. So bring up this first chart now. So this first chart is the refinancing of existing loans. So probably not surprising as you see rates go up. Yeah, in number terms. So that looks really low. 1,000 across all of America? Yeah, I don't know if that's a number. I don't know what that is. That's weird.
It's an index. It's an index level.
Oh, it is too. Yes.
Yeah. So this is from Bespoke.
Good job reading
right?
the headline there. The heading. Nice work. This is from Bespoke. So essentially, this is just tracking the number of mortgage refinancing in the States. And as we've mentioned previously, a 30-year fixed rate is pretty common over there. There's no kind of penalties for getting out of that. So not surprising that with rates having been where they were, now increasing, that refinance activity is
so no one's refinancing now because they've locked in a rate that's lower than what the rates are now.
They have.
And that's why that number is low. So that's obviously it's right.
That makes sense, right? Yeah, absolutely. And so what that means is as rates rise, all those people that have locked in their rates for 30 years, they're insulated from mortgage rates going up.
And isn't that different to what happened during the GFC? So everyone's bringing up the GFC now because of interest rates going up, and look what happened in the GFC.
Yep.
But the GFC was slightly different. Tell me if I'm wrong. We had people with honeymoon rates that were super low for like 2 years, and then they would shoot up from like 2.5% to 7.5%.
Yep.
And that was part of the problem. That's not the entire problem. That's part of the problem. Big
majority of
the
it,
problem.
Yeah.
But that's the complete opposite right now.
Absolutely. So they're the ARMs, the adjustable rate mortgages. So yeah, they'd be 2 to 5 a year of low rates, and then they'd spike up, and people would probably have 3 houses.
Yeah, that's right.
As they get absolutely smashed.
And they're just absolutely geared up to the eyeballs.
Yeah, absolutely. And it's so different this time around because people have been locking in those rates. They've been, you can see here throughout 2020, 2021, the refinancing was quite high. So there's a lot of locked in.
In fact, it was probably as not quite as high as what was going on in 0809.
But look at what's happening there. Yeah, I mean, look at where those spikes are. So 2002, 3, 4, really high.
Yeah.
So that's post-recession. 2008, so post the GFC crash. And then, it's still pretty high through to 2013 there. And that really drops off until 2020, 2021. All right. So we'll bring up this next chart, which is the MBA, Mortgage Buyers Association, I think that stands for. I've got that here. Mortgage Brokers Association. So this is the number
what's this?
This is the number of new loans for newly purchased. So we've got refinance, but now here's for I go out and buy a home. I need to get a
Gotcha.
new loan. And you can see that's really dropping off as well. And I guess, again, that kind of makes sense. With rates going up, house prices are still going up in the States.
So what the hell happened? Obviously, we had 2005 leading up, but that's interesting that the 08, 07, 08 wasn't. This thing looks like it peaked in 05, 06. Is that right? And then it all sort of unraveled from there.
05, 06 then kind of dropped and then bounced, almost
And then that was
last gasp, and then collapsed.
And we haven't come back anywhere near
Not
that.
even close. Yeah.
That's
and
interesting.
Yeah, it probably speaks to, there's been a lot of commentary about the supply shortage in the States. So people just can't buy homes because there just aren't homes to buy. And when you see home sales activity, prices are still going up, but the number of homes selling is falling.
And that makes sense from a supply-demand perspective too,
yeah,
right?
Yep, absolutely. And then this last chart here, which I think is probably for me the most interesting, we'll bring that up. But this is the 4 weeks following the annual peak in applications.
Say that again. 4 weeks.
So you get your annual peak in applications, which tends to be late spring. So what's that? April, May. And then the 4 weeks following that, what is the percentage change in applications? So from the peak in, which I think was May, the peak in May, there's been a 29% decline in new mortgage applications in the 4 weeks following that peak.
And why is that? Is it an interest rate thing? Is it a there's no houses to buy thing? Is it a combination? Like, what is it?
Yeah, I think this time round, you can see the chart there. So you can see if you go back to really 2010 is the last time it's sort of fallen near this level. And the evidence is sort of suggesting it's the interest rates this time around that's having the impact, because unemployment is strong, wages are starting to rise, but interest rates are really just taking off.
But if there are no properties to buy, why would someone put an application in? In America, does it work that way? So in Australia, how we have the approval in principle,
pre-approval.
Is there something like that in America? Or?
Yeah, you still need to have pre-approval before you go out and buy. So that probably makes sense. The reality is it's probably a combination of we just can't find
the
home that I want to, but there's always people on the fringe where they can no longer afford.
Sure.
Or they're resetting their expectations and whatever comes from that. So I just thought it was interesting. And so what we did is tried to find, and we managed to construct a chart of Australian number of loan applications. So we'll bring that up now, and you can see there's a similar trend here. And I guess the most interesting...
Massive shout out to Baharian Wealth Management for that chart. Thanks, guys.
Whoever those guys are. Rates really haven't started to move. And I think this data is up until April. So at that point, we haven't had an interest rate increase. And we're already seeing a bit of drop off in application numbers.
Number of loan applications.
Yeah. So this is for... this is owner occupiers. This is for existing, new, and construction applications.
So we saw it at almost 40,000 applications. What is that? Is that 2021?
Yeah, let's call it 2021.
But it looks like it's been dropping ever since then. And you raise a really good point. There's no interest rate rise in any of this.
No, and this is a 23% decline from the peak. Now the data's pretty volatile.
Hey, it's pretty much in line. I'm sure that'll come down. Off. Not far off from the US numbers.
Yeah, I don't know where the US numbers, where they go to. They could be May numbers. So, if
it's pretty similar.
You factor in the 25 basis point rise we had last month and the 50 this week. I don't know, it could fall off a cliff. You never know.
Although you do point out that the rates didn't rise, and they did not, but there was so much rumor and speculation. Cash rate, the futures cash rate jumped, which indicated that the market was expecting the RBA to hike and hike quite quickly.
And a lot of news about what's going on elsewhere in the world. So that feeds into sentiment.
Yeah. And so maybe all of that just happened before, buy the rumor, sell the news kind of thing. It happened on the rumor of it all. and that's why we're seeing that fall come through now.
Yeah, I mean, it'll be really interesting to look at this data come October, November to sort of see what applications are doing. Yeah, 'cause
Yeah.
it takes a little while for it to feed through. And if the RBA keep going with 50 basis point rise or increases, I mean, we could be well down, below, I don't know, 20,000. I mean, it could really fall off a cliff.
No applications.
Yeah. I don't know. We'll see.
Yeah.
But, I guess if nothing else, this is just a bit of a forward indicator of how consumers are feeling. I mean, construction is such a driver of economic activity that, and home sales, you sell a home, you maybe paint and you do a bit of this, do a bit of that, you buy, you put new carpet in, new furniture, whatever else. So it really is a driver. So yeah, something to watch.
All right, let's jump on to the next one. You got that one?
I got this one too. Man, I'm going to need a break after this. So we kind of touched on this. The RBA raised rates this week, 50 basis points, really kind of caught all but 3 economists that were surveyed by Bloomberg.
Who probably just thought, everyone's betting on
well.
25. Let's just take a punt here and go 50.
So out of 29 economists surveyed by Bloomberg, 3 were predicting a half basis or a 0.5% rise. So kudos to those 3, whoever you are.
Was it Chris Joy?
I'm sure they're listening.
Was Chris Joy one?
I don't know.
Is he an economist?
I'm sure he probably did predict it. Whether he told anyone or not, we'll find out. Anyway, so it caught the market by surprise. I think most people were expecting 25. I think the market had priced in a 40 basis points increase, so even higher than what sort of the market was expecting. I think for me, the most interesting part was the commentary with the RBA saying that they're doing what is necessary and they'll keep doing what's necessary to get inflation under control. Now, I was thinking about this. I wonder whether the Aussie dollar, how much of the low Aussie dollar is factoring into their thinking here? Because if most of the inflation that we've got in Australia is imported, and the Aussie dollar is low, that's just exacerbating the issue. If they get the Aussie dollar to start to increase, then that dampens that imported inflation effect, and maybe does a bit of the work for them. I don't know. What do you think?
For me, I think the bottom line for me is it doesn't matter how many rate hikes we have, whether it's 25 or 50. I think the bottom line is the market is pricing the 2.5% at the end of this year, back end of next year.
Yeah.
Which is pretty friggin' aggressive. Like we're at, what are we now, 0.65?
0.85.
0.85.
So that's what, 1.25.
And so there's another 3 50-point hikes that need to happen, and you're there.
Yeah.
If you actually think about it, it's not that. Yeah, 3 more 50 basis points.
If they go 50 next month, boom,
I'm really curious, like why they surprised the market so much. That to me, I thought if the Reserve Bank's going to be able to do anything, is be able to just kind of talk to markets and calm markets and kind of indicate what they're going to be doing. But to go out and do that, I thought that was pretty aggressive.
And it wasn't that long ago they came out and said, I don't know if they explicitly stated 25 basis points for the next few meetings, but it certainly was implied that it'll be regular increases. I think was what they said. So,
but again, I also think that unless they're raising, they're not going to be able to cut. And we'll talk about. I think you've got on the agenda to chat about the AUD rising, potentially cutting. But unless they're raising, like obviously the bond buying has worked, not worked, who knows? But it's certainly dampened down the yields and kept them pretty low.
Yep.
And I don't know. I think we just need to focus on where we're going, not the path that we are going to take to get there.
Yeah.
And so the other thing is, I don't know why everybody's so surprised that, okay, they indicated 25. You thought 25. They've gone 50. But the market's always pricing in 225 by the end of this year, early next year. And
so it's either 25 every month or a couple of 50 hits, and I think that's what investors need to focus on, is the end outcome here, not how many times we get it takes to rise to get there. Yeah, and I think also let's bring up this chart here showing the countries who have increased by 50 basis points this year, and I mean it's majority of the developed world. Africa pretty sparse there, and Southeast Asia not really at all. But outside of that, Europe overnight indicated that rates are going up next month, 25, and they'll be 25s, I would imagine. They've got other issues going on. But yeah, big chunk of the world by 50 basis points.
I reckon the RBA felt left out.
Maybe. Like New Zealand can do it. Why can't we? And just this other chart I want to bring up really quickly. And this is just Australia's jobless rate is easing, and that is it's dropping at a slower rate. Price pressures are gaining. So the blue is the CPI there. The red is the wage year-on-year wage increases. So all in all, I mean, the Aussie economy it's still doing pretty well. Unemployment is just low, and at this point, it doesn't look like that's going to change. We're starting to see in the US this talk about companies, not hiring and starting to lay people off. We're not getting that sort of talk here. So,
but don't you think Australia? I feel like, and I'm curious on what you think. We've kind of always been a year or two behind what was going on in the US, especially through the boom periods as well.
Yep.
New Zealand might be a bit of a forward indicator as to how things have unraveled since. I feel like they're sort of 9 months, 12 months ahead of Australia as well.
Yeah.
I'm not sure why the Reserve Bank feels like they need to just all of a sudden just catch up to everyone straight away. Whereas we've always kind of, the bond buying program, for example, it's always a couple of years behind what the US has been doing. Yeah. I feel like the 25 would have been in line with what the market was expecting, kind of keep the market relatively calm. I mean, Aussie stocks shed, I think, about 1.5% on the day. You literally saw 230, bang, boom, just
straight line.
Off.
Yeah. I agree. However, the only thing I can think of is they've seen what's happened overseas, that 25 and, even the Fed who've gone 50-50, they're seeing it and it's not having a real impact. So the RBA took a while to get to that point, and now I wonder if they're going, shit, we need to really catch up. The Aussie dollar is low because the US are raising rates, so that's pushing the Aussie low. We really need to support that and get that up because, most of the inflation isn't domestic demand, it's international.
Correct.
So the only way that the RBA can affect that is through the Aussie dollar.
Yeah.
I don't know. We'll see. But anyway, that brings us on very nicely to the next topic. So UBS came out with a research report saying that the Aussie dollar could well be one of the best trades of the year. So
what does that mean?
That means get on board. So what they're talking about here is for international investors selling.
Is that from the Aussie UBS team?
No, it's the head of Asia. So no,
sorry,
unless he's here in Australia. Anyway, I was saying something about. So what that means is international investors sell their currency and buy the Australian dollar. So as the Australian dollar goes up relative to their currency, they're making money. And then at some point they unwind that, sell the Aussie.
Surely it depends on what you're converting from, right? And what you're using to buy. No?
Well, I guess the general thought is it will outperform relative to every other currency.
All other currencies?
Yeah. I mean, that's probably a big call because there are other commodity-based economies like the Canadian dollar, the South African rand. So, maybe they're a bit different. South Africa is probably a different case, but certainly Canadian and Aussie dollars tend to perform fairly similar and similar drivers. But the slowing US economy, a brisk growth in Australia will trigger a rally in the Aussie dollar to levels last seen more than a year ago. So may not seem like a long time back, but the Aussie dollar has fallen quite a bit over that period. So they're saying that the Aussie could rally as much as 11%, get up to about 76 US, possibly 78 by the first quarter next year. So what's that, March? And we're trading at about 71.5 US at the moment for reference. So, it's a decent rally. So bring this chart up here. This is what the Aussie dollar has done since June last year. So about a year. And you can see it's come off from about 78 down to 71.8 here on the chart. Got down to, I think it was 69 is where it got down to. a few weeks ago. But I guess when you stand back and think about it, so soft commodity exports, wheat, corn, etc. The Ukraine, and obviously they're a big exporter. India have stopped exporting wheat, trying to keep it internally so they don't have food shortages.
And more bread inflation.
Possibly. Who knows? We talked about that a couple of weeks ago.
Yeah,
the hard commodities, China coming out of their lockdowns, iron ore is generally a beneficial. Coal has been on fire this year. Oil that we've seen is on fire. Gas also. So they're all, pretty strong tailwinds for the Aussie dollar.
So does that mean that the RBA may not need to do as much then if we've got China opening up, for example?
Yeah, quite possibly. Yeah, I mean that would be really interesting. I mean, if the Aussie dollar gets up to 76, does the RBA pause? Unless they want it to go higher. But, if the RBA continue to raise rates, again, that's another tailwind. And, pretty good economic growth. So, just one that caught my eye. The other thing I'll just note on this is the Aussie is the second best performing currency out of the group of 10 this year, behind Canadian dollar. So, it has been pretty solid this year, but over the last 12 months.
Did UBS talk about the Argentinians using their pesos to buy Aussie dollars at all? Is that a good trade?
No, I didn't see that. They'd have to sell their Bitcoin. Didn't they buy a bunch of Bitcoin?
That was Venezuela.
Oh, was it?
Yeah.
They're all the same. I don't know.
Although apparently, so this is the peso to the dollar.
To the Aussie or US?
To the Aussie dollar. It's like the lowest it's ever been. It's crazy. It's like
really?
0.012 Aussie dollar. So one Argentine peso buys 0.012 Australian dollar. Is that 1 cent? I think that's 1 cent. It buys 1 cent. Apparently,
wow. So we're all billionaires in Argentina.
Well, I think it's sitting up at like 80% in Argentina.
Is that right? Far out.
Apparently, criminals are not stealing money anymore because it's not worth it. Not worth anything.
Not worth their time.
No, it's dead set. It's Bloomberg had an article on it. Criminals are not stealing.
What are they stealing?
I'm not sure what they're stealing anymore, but apparently the economy is still
trees.
The economy is still going quite well. So the casinos are packed apparently, and they've got Ferraris being showcased in casinos now. So
seriously,
yeah. I'm not sure what's going on there.
It's just
crazy, a bit bizarre. But let's get back to the Australian dollar, because I think the next topic, I think that's yours anyway. But that's the big one, I reckon.
Yeah, absolutely. So CBA's head of Australian economics, Gareth Aird. I'm sure I got that wrong, but anyway, Gareth came out and has basically said that that the RBA will start cutting interest rates in 2023, which is a little crazy.
On you, Gareth. I think that's a solid call.
Yeah, I think it probably is too. So they've downgraded GDP growth forecasts in Australia to 3.5% this year, down from 4.7%. So that's a pretty big decline.
25% decline.
And then it will slow to 2.1% in 2023, which is below trend.
Right.
3.1 is where they thought it was. So they're basically saying the RBA looks very intent on dropping the inflation rate quickly. And because of that, they've sort of changed their expectations.
How does the RBA control ships and bottlenecks around the world? I'm curious about
with
that.
regard to
like raising rates here, what impact that has on global.
See, this is where I think it's all about the Aussie dollar. I mean, they can't impact anything except the what it costs us in Australian dollars. Yeah, but again, people in Shanghai on the docks, they're worried. They're watching what the RBA are doing. So again, Phil Lowe basically said we're doing what's necessary to ensure inflation gets back to the 2 to 3% target band. And in that earlier graph, what was inflation? 5.1. So they've got a little bit of work to do. Petrol prices are bloody $2.25, so that's not helping.
Yeah.
So and that feeds into.
But the dollar has that. Price of oil and dollar, that all has a massive impact, which feeds into inflation. So I understand that.
Yeah, definitely. So, so let's bring up this chart here. It's probably easier to go through this chart rather than the rest of the article. But so essentially, table here is rate calls by the RBA. So CBA are basically saying that by July this year, the official rate will be 1.3. It's currently 0.85. And by December, it'll be just a smidgen over 2%. Whereas the market, which is OIS, I'm not sure what that stands for, but that's the market, they're saying 1.2 in July, which is interesting, below what CBA, but they're saying by 3.1 by the end of the year.
Now, these are CBA's call.
The 2.05.
Yeah, that's right.
Yeah, that's what CBA is saying. That's where they think rates will be, whereas the market's saying 3.1 by the end of this year.
Sure.
That's
Where do you think we're going to be?
I think we're going to be much closer to 2%. Than we are 3%. And so obviously the risk, which we've talked about before, is unlike the US where we saw there's a whole lot of 30-year fixed rates and no one's refinancing. Here, vast majority of rates are on variable. And if you fixed over the last few years, you probably fixed part of your loan.
40% of residential homes are fixed. Massive shout out to CBRE for their research. Did you get that note that I flicked you?
Yeah, I didn't read it.
Yeah.
I haven't got time.
So
I was preparing for the podcast.
Residential property, 40% of home loans are fixed.
Now, is that they've fixed all of the home loan or part of the home loan?
40% of home loans. So 100% of home loans, 40% are fixed. It doesn't matter how much. It's just 40% of home loans are fixed.
Okay. So
if you took one sample consumer or household, 40% of their loan is fixed.
And 60% is variable.
And in fact,
so they're still exposed, but just not as exposed.
Yeah, 100%. And who wouldn't have been fixing over the last 2 or 3 years? Yeah. The problem is once those fixed rates mature. But having said that, that might be enough time for us to go through whatever we need to go through, and then we trough again.
Yeah. So a lot of people fixed over the last couple of years for 2 years. So from 2021.
Sure.
So I think the majority of those fixed rates are 2 years and expiring in 2023.
Looks at this and kind of tries to marry all this up to go, shit, what if everything's on variable? Rates are people are going, 40% of loan borrowers are paying it at 2%. And then once this comes off, they're going to be at 5.
Yeah. I mean, that's a massive hit.
That'll be a massive hit to the economy.
Yeah, absolutely. And that's the concern, is that as rates go higher with so much of 60% of loans being variable, it has a big impact, but it has a massive impact, say, mid-late next year, which lines up with where CBA is saying that there's going to be a rate cut. And just for note, they're forecasting a 50 basis points cut in the second half of 2023.
Mate, no one knows what's going to happen next month, let alone what happens in the second half of 2023.
Well, I tell you what, let's go, mate. Let's check back.
Gareth, this is his name, Gareth, right?
Yeah.
Just something else I think was really interesting. Majority of REIT loan books are 55 to 65% hedged for 2022.
REIT loan books. Okay. 2022. But
all of this year.
Yeah, not next year.
No. Gearing is sitting at about 28%.
That's pretty low.
Historically low, yep.
Yeah.
And so what CBRE is saying, they're largely immune on the current loan book.
For now.
Yeah, for now.
Yeah. Just to round all this off, just one other economist, James McIntyre from Bloomberg Economics, came out and said, were the RBA to tighten as much as markets project, it would trigger a recession, forcing it to reverse course and cut rates as soon as the second half of 2023. So, look, it's fascinating. I think there were people at the start of this year calling for a recession in 2024, I think they were saying.
You're looking at yourself?
Look, we may not get a recession. We might just get a decline, as in a big reduction in growth, but not negative growth, and a reduction in inflation.
Let's jump on to what Jamie Dimon has to say of JP Morgan. Is JP Morgan the biggest bank in the world?
They've got to be close if they're not.
So he came out at a conference last week. Let's have a quick look.
Who else would be? Maybe one of Deutsche Bank?
JP Morgan.
Is it? Okay. Who's second?
10 biggest banks. Oh, I'm sorry. Commercial Bank of China, JP Morgan. Maybe the Commercial Bank of China is not included, JP Morgan. So the CEO of the biggest bank in the world comes out with this headline, or Bloomberg came out with this headline. Jamie Dimon says JP Morgan is bracing itself for economic hurricane. I'll quote Jamie Dimon here. That hurricane is right out there down the road coming our way. We don't know if it's a minor one or a superstorm Sandy. Do you remember Superstorm Sandy?
I do remember Sandy.
You better brace yourself. And he's saying right now it's kind of sunny. Things are doing fine. Everyone thinks the Fed can handle it. But he then goes on to talk about the strength of the consumer, rising wages and plentiful jobs as the bright clouds in the economy. I'm a little bit confused about his weather forecast. JP Morgan CEO is now a meteorologist.
He's about as, well, we'll find out whether he's more accurate than the actual meteorologist.
But he goes on to say JP Morgan is preparing for that turbulence by being conservative with its balance sheet. And I think that's really, really important.
Yeah.
Now, we all know what's going on in the market right now and what everybody's concerned about. A couple of headlines I read. Tesla pauses hiring as Musk aims for 10% staff cut. Now, not Reuters. That's who wrote the article. Tesla have about 100,000 employees.
Yes.
And so they're cutting 10% of their workforce. You've got about 10,000 layoffs there. Credit Suisse has come in and announced they're going to be doing a new round of job cuts as well. And then you've got articles being published now, such as this one. Black Swan investor is watching for the greatest credit bubble to pop. Corporate bond breakdown may cause failure, Spitznagel says. I think that's his name. Hedge fund university protects against the biggest market risks. And so I'm just wondering, is all of this a self-fulfilling prophecy?
Yeah.
Are we manifesting a recession onto ourselves? And the fact that everyone is so fearful about this impeding recession that we actually have a recession.
Yeah,
what do you think?
It's entirely possible we talk ourselves into it. And I think, yeah, I mean, I'd probably bet good money that as consumer sentiment falls and they start to pull back spending, then we have the recession because no one's spending. And I think, people are swayed by headlines.
Yeah.
I mean, we see it all the time, and you just look on the news, and if we start to get, as I mentioned earlier, we haven't seen this sort of negative commentary around jobs in Australia, but in the US, it's more and more. There are a few other companies a few weeks ago that came out and said very similar things. I'm trying to think who they were, but I know a lot of crypto-related businesses are cutting. Some of the tech, I think Facebook came out and said they're pausing, not hiring anymore. Twitter are looking to cut some people. So, maybe there's specific companies here and there at the moment, but if that starts to gather a bit of steam, and ultimately this is what the Fed and central banks want, not people to lose their job, but for the economy to slow. I mean, this is the whole idea of raising rates. So, I wonder if they're sitting back, maybe going, well, good.
But do you think it could be all possible that the fact that, these ridiculous headlines are being published, that we're at this point now where we actually don't have a recession because it's sort of almost contrarian to the extent that if everyone thinks it, then sure, maybe it might happen, but also it could not happen, and everyone's gone so far to the other end. Jamie Dimon talking about we're managing our balance sheet accordingly. To me, that's the biggest thing. The CEO of the biggest bank in the world is saying we are bracing for a hurricane. What do you think that means? Maybe that's why no one's applying for friggin' loans. Or maybe they are and they're being declined and it doesn't get into the number because JP Morgan's saying, no, we're not lending any money. And so all of a sudden, when the biggest bank in the world says we're going to brace for this hurricane, what impact do you think that has on the rest of the economy? It's huge.
Massive. And other businesses as well.
100%.
I mean, because, if you're a smaller bank going, oh, shit, if that's what they're saying, then what are we missing? Are we missing something? I think you're right. The most interesting thing for me is that he's not just saying this, they're actually doing it. And so, look, what a cheery start to the podcast. But
I'm wondering how we're in a recession. Qantas came out with two announcements. The first one is Qantas is so stretched it needs office staff to work as ground crew. So from an Australian perspective, we're so short, and people are now traveling so much. The second thing is, and I don't know how we're in a recession at the same time. It's like two parallel universes at the same time. Business class flights are doubling in price, and Qantas is saying people are still paying for them.
Oh, wow. Really?
How are we in a recession when you've got consumers buying business class trips that have doubled in price with Qantas?
Yeah. Oh, God. I don't know.
It just doesn't make any sense.
Yeah, it doesn't. You're right. That's I hadn't seen that. That's interesting. But I had heard about Qantas's staff shortages, and I mean, Qantas must have some pretty good hedging of their fuel prices because they've gone up
Well, they'd have to.
insanely.
What's gone up insanely? Qantas share price?
Fuel.
Oh, fuel. Yeah, 100%.
Yeah, I mean that's the biggest cost I think for airlines. Yeah, so they're obviously going to push prices up. The travel stocks are doing well. I think Webjet came out a couple of weeks ago and said, they're seeing huge demand. So it's not surprising that
Qantas is saying the
that's
same thing.
flying into Qantas. I also saw, just as a side note, that Virgin are looking to IPO next year once they've got their balance sheet in order. So they're probably doing fairly well. So yeah, I mean, it's not
just get rid of it.
What's that?
Give it to the public.
Yeah, we've loaded it up with debt.
Give it to the public.
Whoever wants it. There's mixed kind of commentary and behavior and actions going on. I think is probably like with everything. It's never all one way traffic, and we're at that point. Whether we're a turning point or not, again with the RBA raising rates pretty aggressively, we'll see what sort of impact that has in a few months.
Well, part of me says we're not going to have a recession when Cardi B is tweeting, when y'all think they're going to announce that we're going into recession. That was her tweet. So next thing I wanted to talk about just on the whole inflation thing is Target, who is off target again. A little bit of a pun there. But so the headline is Target's oversupply problem should scare all retailers. So remember how a few weeks ago we chatted about Target's poor guidance and their announcement on their earnings and their profit warning. That's 3 or 4 weeks ago now.
Yeah.
And so they've come out again cutting their outlook. And now the reason why they're cutting their outlook is because they've just stuck with a shit ton of inventory. And so there clearly hasn't been anything happening to help clean that up.
Yep.
We've obviously got rate rises, job cuts, and the consumer outlook is quite bleak. And we're also at a change of season as well, where you've got retailers having to put in new orders. Now, I don't know. Well, I know where Target's supplies are coming from: Bangladesh, Pakistan, Sri Lanka, America, and I think there was another country, I can't remember. But I don't know what the split is between offshore and onshore. Quote, Target is talking to suppliers to shorten lead times. I don't know how that happens unless and if there are shipping bottlenecks, how do you get something on a shorter lead time? They're stuck with all this stock. And I think all of that is going to be deflationary to the extent that they've got a ton of inventories. We talked about this, TK Maxx, what are the other?
Ross.
Yeah,
Ross
so
stores.
What are they, sort of lower tier retailers, if you like? Or
yeah, they just sell out of season stock.
Out of season
so
stock. What do you call those types of retailers?
I don't know.
I don't know.
They're not seconds.
No, they're not seconds. They just don't sell what's
just out of season.
Out of season retailers.
Yeah.
And so there's a boom there, but the fact that the reason why it's such a big issue because Target is looked at as such a well-run company that if they're facing these types of problems, then you've got the likes of the Walmarts or the Costco's or Nordstrom, whoever it is, that are going to face similar problems with inventory. And so I think if Target are going to be trying to get rid of all this stock, I mean, what are they going to do? Cut prices?
They've got to discount
it. Target came out about not wanting to have their floor space looking like what you think it might look like if you've got too much stock.
Yep.
And so I think that's problematic. Like, how do you manage your inventory without your store being looking like a basement bargain store?
Like JB Hi-Fi.
I don't know.
Yeah, I mean, that's their
that's
their thing. Like a warehouse feels like everything's on sale, feels like it's
correct.
cheap. So Yeah, I don't know how they do that apart from literally open up the warehouse and let people come in.
Yeah, I mean, companies here, Adidas, I've been to some of them, like Adidas have done it where they've opened, we've got tons of stock and it's basically for nothing.
Yeah.
And it all goes.
Yep.
But I think that's deflationary to some extent. I don't know how much.
Depends. I guess depends on the extent. You know, if it's Walmart and it's Target and it's whoever else, then obviously that has a dampening effect. But if it's just Target because they just screwed up and ordered too much, and Walmart are able to manage it better, then it's a one-off, and consumers go there and not to Walmart. So maybe then Walmart goes, well, shit, now we've got a lot of stock. Maybe it has a knock-on effect.
Yeah, it'd be really interesting to see how that plays out. The next one, I just want to keep with this inflation theme. There's Bloomberg had an article, and this is really, really interesting and fascinating, I thought, and it kind of aligned, and I'm biased here because it kind of aligned with some of the comments that we've been making over the last few weeks, but not bragging here, but I think we might be on the right track. Currently, quote, 3 of the key supply side factors driving today's global inflation levels have already turned around, meaning relief could be on the horizon for shoppers worldwide. And so I just want to bring this first chart up, and it's showing in Spectrum Tech, and I'll talk about semiconductors in a second. You've got the shipping index, and then you've got the fertilizer index. Now, it doesn't look like on face value that there's a sharp decline here, but in relative percentage terms, they're pretty big declines. Now, while I've got this chart up here for you, let me just go through all of these. Hold on, let me just get this up. All right. And I just want to talk about each of these ones, and I'll just quote these from Bloomberg. Bellwether semiconductor price, which is on what you can see in the Spectrum Tech PC, a barometer of costs of finished electronic products as diverse as laptops, dishwashers, LED bulbs, and medical devices delivered worldwide, is now half its July 2018 peak and down 14% from the middle of last year. The spot rate for shipping containers, which tells us more about expenses we can expect later in the pipeline for apparel in Chicago, luxury items in Singapore, or home furnishings in Europe, has declined 26% since its September 2021 all-time high. North America's fertilizer prices, which is a far right-hand column, the last graph you can see in that chart over there.
Welcome.
And an indicator of where global food inflation is going, including bills for tomatoes in London, onions for sale in Johannesburg market, and is 24% below its record high in March. And so with all of that going on, with the likes of Target or whoever may be retailers with supply, I'm curious to know, what do you think about all of this and the fact that rates are still rising, growth slowing? We've got inflation coming out tomorrow, our time.
Yes.
So listeners, by the time they hear this podcast, it would be 4 or 5 days anyway. So that number would have come out.
Yep.
And so I think that's a really, really important number to look at because, you and I have talked about this, because of the year-on-year growth coming down. So all of those, for all of those reasons, I reckon we've turned the corner on inflation.
Yeah,
I'm calling it now. We've turned the corner.
Oh, look out! That's it.
I'm stamping this right
now. The inflation number tonight will be interesting. The month-on-month number will be interesting. That might be slightly higher, but the year-on-year is the key one.
Yep.
But also, just to throw something else in there, which I read briefly this morning, the unemployment claims in the US, which came out overnight. So that is the weekly number of people that are claiming unemployment benefits over the last week. That unexpectedly jumped in the US. And whether that's people coming back into the workforce, I don't think that's it. It's more about people losing their jobs. All of this kind of coming into the fray, and your wonderful analogy last week of the drinking and inflation. Brilliant. So we're what, 3 pots, 4 pots, pints in at the moment with the Fed, starting to feel a little tipsy.
Definitely pints with the RBA, not the pots.
Yeah. the inflation's starting to come down. By the time we get absolutely hammered, i.e. the rate increases really take effect in the US, I mean, inflation could be well on its way down. And, you know, the shipping index is one where I think that has probably a fairly immediate impact on inflation. So any container ship coming over now, they're charging a lot less, which will flow really quickly into the prices that retailers are paying. Fertilizer probably takes a little bit longer, I would imagine. It takes longer for crops to grow, et cetera, et cetera. And the other one, which was the chips, that's probably fairly quick too, I would think. Unless they're contract priced out or something, I don't know.
Yeah, although you get different data from different sources. So I think it'd be fascinating to see what the numbers come in at. Just anecdotally, I was talking to someone who races cars, and he was saying, this was a week or so ago now, he was saying normally it would cost him to cargo his car from Australia to America or to England, might cost him about $4,000 each way.
Yeah, right.
Guess what it costs him at the moment to try and ship it?
10?
20.
Holy shit.
Yeah,
seriously?
20K. So I'm like, so you're not racing the car? He's like, nope.
No, far out.
And
that's crazy.
Yeah, and look, that's just anecdotal, but I think as we go down this path of this new world and we start venturing into this pretty prickly jungle, I reckon we are going to get cut. We're going to bleed. We're going to have some bruises along the way.
Yep.
But how long it lasts, no one knows.
How quickly we get there, I think, is probably now the question.
Well, let's talk about this.
Are we there yet, Rob? In recession yet?
Well, I'm going to say no.
Trying to lead you into the next.
I'm going to say no because the topic is what recession, and this is fascinating to me, and it really changed my thinking around where I think the world is at, the economy is at, because we can get so influenced by what is going on, the headlines that we're reading, and I feel like the headlines have now gone from nothing to talk about COVID anymore. The Ukraine-Russia thing is still going. I feel like no one gives a shit about it anymore. Yeah. What happened with We Stand With Ukraine?
Feels a bit like that, doesn't it?
Gone, fizzled away.
Which is what Putin wants.
And now if Cardi B's talking about recessions, like recessions are things that the papers talk about. So I feel like we can get so swayed by what's going on that we forget fundamentally in the economy what is going on.
Yep.
And so obviously we've got inflation and rates happening now. Now I think, and here's why I think we are not in a recession now, and I don't think we're going to have one in the short term. I know I'm changing my tune here, but just please hear me out, and I will try and convince you with this one chart. It was published by Deutsche Bank. So it came through the other day. In fact, it came through at the back end of our prep for the last week's pod. That's why I said I've changed my tune.
Yeah.
So the Philly Fed just updated their data. And I will bring this chart up now and I will explain to you what it is looking at.
Mm-hmm.
So this is Deutsche Bank. One fascinating bit of supporting evidence was updated data yesterday from the Philly Fed, who publish a coincident index. The quality of the chart should not deteriorate because of the name of the index, but it is a coincident index on US on a state by state level basis that tries to capture the outlook in each state based on payrolls, manufacturing hours worked, the unemployment rate, and real wages. Okay. So it's a broad-based economic indicator.
Mm-hmm.
And I'll read the heading there, the chart. So Philly Fed, state coincident index, number of states showing number of states showing increasing activity. A US recession has needed 5 states to see declining activity for at least 7 months before starting. So interesting point of data was in 2019. If you have a look at the chart there. So basically what it's saying is the number of states on the left and right-hand side and the number of states with increasing activity, you see the massive decline in 2020 when the pandemic hit.
Yep.
I think what's more interesting is forget the pandemic, which hit in 2020. Look what was going on in 2019.
Yeah. There was already some
There was
pain
there was
starting to
30.
happen.
Well, what that's saying is there was close to 15 states that were seeing some of these issues.
Yep.
Now, Deutsche Bank go on. I'll explain this in a minute, but then we had the pandemic, and then all of a sudden we've just. So there are no states that are indicating any stress here. And so going back to 1979, we have never, ever, ever had a recession when 0 states have seen deterioration in their economic activity.
Yeah. And even further to that, it's more than 15 by the looks of it before a recession. You know, like look back in 79, 15 was about the number, then it fell off a cliff.
Yep.
87, it was 15 and it bounced back. It was fine.
I see what you're saying.
95, 15, it was fine. So it seems to be, it needs, they've said, what do they say here? 5 states. 5 states for at least 7 months. Okay. So
they go on to say not every 5+ state activity decline leads to a recession, but a recession hasn't happened without a 5-state decline for at least 7 consecutive months in the history of the data.
Right, I'm with you.
And so this is not, all this is saying is the 7 months might not start yet. So the 7 months, it could start coming down. And so we're at least
7 months
away for seeing anything. And so for that reason, this year off, potentially even 2023, Deutsche Bank are standing with their second half of 2023 recession. Yeah. Which might lead into your Q1 2024 recession.
There you go. And interest rates being cut the back half 100%. Of next year.
100%. So the other thing is we've never had a recession when central banks around the world have started started to increase rates so early on. We have not had a recession so early on in the rate rising cycle.
Yeah, and I think
because the recession happens after the rate cycle peaks.
Yep.
Am I making sense?
Yeah.
You hear me? So for these reasons, Matthew and listeners, I have changed my tune and I'm saying we are not in a recession. I'm saying we're not going to have a recession. This is my punt, right? We're not having a recession this year, and we're probably not going to have a recession next year. And
not next year either.
Well, certainly for the first half. So I'll be data dependent.
You walk back on that pretty quick.
I will be data dependent as we progress through time.
Yeah, I agree. We won't this year. We're basically running out of time to have a recession this year, really.
Correct.
2 negative quarters, but it will. The second half of this year, I think, will dictate when the recession is. And so what I mean by that is how hard or for how long the Fed and RBA continue to raise rates will dictate how quickly we'll be in recession. So if the RBA...
because the market's already priced in 2.2 or 2.5%. So it doesn't matter what the RBA do.
100% it matters what they do.
No, I disagree.
So if the RBA goes 50-50-50...
Yep, and stops at 2.5, let's say.
Right.
Yep.
But that isn't flowing into... So whatever the market's saying, they're saying, but that's not flowing into
the real economy.
My mortgage payments right now.
Sure.
That's where the rubber hits the road, right?
Yeah, fixed rates are.
Fixed rate, sure.
Yes.
But that's what I mean, that if the RBA go hard for the rest of this year, we'll be in recession next year.
I understand.
But if they stop after one more 50 basis points, the Aussie dollar pops up, they're comfortable, then maybe we avoid recession next year.
And the market's wrong.
And the market's wrong. Yeah. And bond prices come down, go up, rates come down, stock market goes up, everyone's happy. And, one is as likely as the other, I think, at this point. But the more they raise rates, the more it starts to tilt towards recession.
Yep.
Earlier rather than later. And we're going to have a recession. I mean, everyone knows that. It's just when will it be?
And how severe is the recession?
How severe, yeah. And how far, to your point, how much of an interest rate unwind can they enact? So if they have to cut rates from here, there's not really a lot they can do. But if they get rates up to 2.5%, 3%, then they've got a bit more ammunition to fire to get things started again.
And I think the 3% is probably on the higher end. My gut says in the 2 or the low 2s is probably they'll land.
Yeah.
I feel like that's enough headroom to go, we're cutting 25, cutting 25. Can you imagine then when the market hears the RBA in the second half of 2023, 25 cut, 25 cut, 25 cut, 20. You've done 4 consecutive months of 25 cuts, and then you've gone from, let's say, 2.5 to 1.5%. I feel like that psychologically makes a big difference.
So the regular cuts as opposed to a big boom boom.
Yeah, correct.
Yeah.
Well, you don't want to go too big boom boom because then you got no ammo left.
Yeah, that's right. And then potentially you have to go back up. You don't want to drop 50, drop
Correct.
50, 2 months later, go up 25. Kind of indicates you don't know what the fuck
Gareth,
you're doing.
if you're listening, we're with you on this one.
Yeah.
I think he's right.
I think he's at this point. I'd say he's looking pretty good.
Let's jump into director's cuts.
All right. So the first one here, I'll take.
So you or me?
Kate, hey.
What are you looking at?
Oh, you've been talking, so I'm gonna give you a bit of relief.
Yeah, go for it.
So KFC. I don't know if anyone has been to KFC recently, but the floods in Queensland are wreaking havoc on
Wreaking or wrecking?
Wreaking.
Okay.
I don't know.
Reeking. My kids say you reek. Like you smell.
I don't know. We'll look it up. Anyway, causing havoc, creating havoc on lettuces and KFC being able to get lettuce. So they're now putting cabbage into their burgers.
Have you actually seen it?
I haven't, but I'd be like, just hold the cabbage. Don't worry about it.
No, well, I haven't seen KFC doing it.
I'm not buying my burger for the lettuce anyway. So,
well, I'm vegan, so all I eat is lettuce.
Well,
and
I'm gluten.
water.
I can't have any of it. So I'm just literally getting chips. That's it.
But last week I was at the market and I went to grab an iceberg lettuce because I don't know. I'm in the mode of eating iceberg.
Yep.
It was $8.99, and I thought, what the fuck is going on with iceberg lettuce? Until I did my readings on Monday, and thank you Bloomberg for letting me know exactly what was going on. Yeah, it's
Well, I think it's like $10.
$11.99.
$11.99 in supermarket.
$12.
Wow, man, that's nuts.
For a
who's buying it?
They're going to have excess inventory. They're going to have to chuck out. Who's going to buy $12 head of iceberg lettuce?
It's easy to get a packet of Oreos for $1.
Mate, just get rid of them. Shut up, Melbourne. You did not even make the list. Bloomberg, these are the world's 20 most expensive cities for expats, admittingly for expats, but I still throw it in the mix there. 20. So I went through this list. I combed through this list of 20 cities around the world. And yes, you're complaining about our $6 lattes, your $12 iceberg lettuce, and the expensive property prices. Guess what? You weren't even on the friggin' list.
Yeah, right.
Hong Kong, number 1, New York, Geneva, London, Tokyo, Tel Aviv, Zurich, Shanghai, and the list goes on. Melbourne, you are not there, so shut up. What else we got on the list?
The last one.
Oh, yeah.
You can take this one. I didn't actually read this.
Yeah, so Robert Shiller, Nobel Prize winning economist, who I'm sure you know, but just for listeners, Nobel Prize winning economist, spoke at a wealth management conference in the US last week. And he was talking about, I think he may have been asked about current market valuations. He was talking about current market valuations. I quote Bob Shiller, it has come down into the low 30s. I think he was talking about the CAPE ratio, which is and for those who don't know what the CAPE ratio, cyclically adjusted price earnings index number. And what it measures is the price people are willing to pay, investors are willing to pay for $1 of earnings from a company.
It essentially smooths out.
It smooths it out. So instead of looking at it one by one, 1 year by 1 year, it looks at it looks retrospectively over the last 10 years and smooths it out.
Yep.
And so Bob Shiller created the index or the ratio. And so, quote, it has come down into the low 30s, he said. It kind of puts us where we were in other times in history that were relatively extreme. But, the stock market has performed very well over the last 100 years. I like to look at long-term time horizons. And so when it's highly priced, it doesn't necessarily make it a horrible investment.
Mm.
And I thought
that was interesting.
It's quite profound, but it's not. It's so simple, but it makes a lot of sense, right?
Yeah.
And so the things I took out of that were you can't time it. It can remain at elevated levels for a really long period of time.
Yep.
But I also think it goes back to your time horizon. So if you're an investor that is a retiree who might be 60, 65, 70 years of age or 75 years of age, you may not be able to look at a 30-year time horizon. Maybe your time horizon's, a rolling 5, 7, 10-year time horizon.
Yeah.
Whereas if you're a 40-year-old working in a good job, your time horizon is very, very different. And so because of that, I think asset allocation is incredibly important. If you're going to play the game of the stock market, you need to understand you're going to have to go through this. So don't blame the stock market. You need to understand how you mix up your assets.
Yeah. It's a price of admission, as we've said before.
100%.
Yeah. And, diversification, and you can be 100% stock invested, but you still need to diversify. So if you're 100% tech, then you're going to have some shocking
We looked at it
years.
last week. Value stocks have been on absolute tear,
Yes.
up 12%.
Yep.
Australian value stocks up 12% in 2022. Meanwhile, US tech, US growth stocks, we saw in the NASDAQ down from highs, or you had it, 25, 26%.
Yeah, thereabouts. Yep, absolutely.
Let's wrap up with tips and recommendations.
All right, mate.
What do you got for us?
So I went out, finally got out of the house without the kids. Just
What's that, first time in
Laura and
how
I,
long?
first couple of years, in a long, long time. So I went to a Mexican... Thank you. Went to a Mexican restaurant in Hawthorne called La Cabra.
La Capra. How do you spell it?
Modern Mexican. So LA, Cabra. So it's in.
Cabra.
It says it's in Hawthorne, but I mean, really, it was Camberwell.
Modern Mexican, right?
For my geographic knowledge, it was just off Burke Road. Anyway, it was quite good. They had a.
Did I give you this tip?
No. I ignored all yours.
Why'd you ask me for the tips?
Oh, because anyway, they had a 21st function out the back. So basically, you'd normally dine in the front or out the back,
right?
And everyone was crammed in the front. And look, they were really, they're really apologetic that everyone was crammed in, but they were absolutely lovely. Service was pretty good. They kind of gave us a free dessert because of the chaos that was going on in the restaurant. So that was nice.
I think those little things are so valuable, aren't they?
Yeah. No, they are. And it kind of, we were just like, oh, okay. Didn't even ask for it. Didn't expect it. Food was pretty good. Probably a little spicy for Laura's liking, but I quite liked it. But yeah, look, quite nice. Pretty cool atmosphere. For an old man like me who's deaf, a bit loud, but that's because I'm old. What did I eat? It was a burrito bowl. So they had a few gluten-free options.
Oh, okay.
They had gluten-free dessert, which was that's right. It was a brownie, warm chocolate ice cream on top. Oh man, it was so good. I'd go there just for that. That was so good.
Can you have nachos?
Yeah, man. Corn's gluten-free.
Corn.
Yeah. Corn chips.
Gluten in corn chips?
No.
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 But you can't have
wheat.
Yeah, so you can't have the burrito.
Yeah, but they have corn.
Yeah,
tortillas.
that's a traditional one, isn't it?
And they're shit.
Really?
The soft ones, because they just fall apart. The gluten, I guess, is the binding agent. I don't know. Anyway, it was quite good. They're probably well known. They've got a number of sites, much like Munro's up in Hillsville, which I'd never heard of. Everyone's probably out there going, no, dickhead. Everyone knows about this restaurant. But anyway, it was quite good. I quite liked it. I'd definitely go back there again.
Yeah, cool.
Look, out of 5, I'd give it a 4, 4.5.
Wow, that's solid.
It was a pretty reasonable price. We did have a couple of drinks.
Do you have any vegan options?
No, mate.
Oh, char-grilled, char-grilled corn, gluten-free, loaded crisps. Yum, that looks good.
Yeah, their margaritas were bloody strong.
Did you drive or did you guys get an Uber?
I drove there and then...
Shame.
We got a margarita and Laura had like 3 sips. She's like, this one is all yours. So I think a couple. And they packed some punch.
Yeah, nice.
I was probably 3 interest rate increases in. That's where I was at.
Very good. Cool.
Yeah, so quite good. What do you got?
So you didn't take Laura to Taco Ball in the end?
No, look, as appealing as it is,
we're heading to recession.
Right.
Taco Ball could be thriving.
So I've got to have something up my sleeve,
That's true. All right, so we're going with the food theme here. We went out for dinner for Julius's birthday yesterday. So he turned 8. And so he... thank you. So we went out. He's one of his favorite cuisines, Indian. So we went out and keeping it local for you because I know you don't like to tread out of the Blackburn perimeter. Blackburn South, if you can go there.
It's a long way.
Saffron House Indian restaurant, Canterbury Road, Blackburn South. Little group of shops. I think they've been there for many, many, many years.
Is that up around the Safeway, like that area?
It's across the road. Yeah.
Yep.
So they do free delivery. So
Right,
you might be able to sneak a little delivery
nice.
in there. We really like it. I reckon maybe some of my Indian friends would say it's not like traditional Indian because they use probably like a lot of powders and stuff like that.
Yep.
But anyway, we really liked it. Julius loved it. We've gone there for a number of years now. But the kicker, so you should go there and try it. Do you like Indian food?
Yeah, mate. Love it.
Oh, that's right. Laura doesn't like Indian food.
Yeah.
Maybe we should do Indian one night. The kicker, have you ever had Indian pickled vegetables?
Never.
Man, you like spice?
Yeah.
It is like a spicy and the saltiest thing you'll ever eat in your life. And so they've got like it's not like it's pickled vegetables. They've got carrot and mango and a whole bunch of other things, but like in chunks.
Yeah.
Tomato, peppers, etc. And I don't know what the process is, but basically it's pickled and it is salty as chili. He's salivating right now. And man, all you need is
I'm hungry.
is this little side dish and it is bloody good. So listeners, if you're go to an Indian grocery store and just pick yourself up a little jar of Indian pickled vegetable or whatever it is.
Yep.
But they will know what it is. And if you like Indian food, man, it goes well.
Yeah, okay. All right.
So there's my recommendation for today. We have gone well and truly over time. So if you're watching or listening, put it on 1.25 speed or 1.5 speed. You'll get through it in good time. Hit us up, YouTube, Spotify, and wherever else listen to your podcasts, and we'll catch you next week.
Cheers.
My name's Robert Baharian, and I'm the founder and CEO of Baharian Wealth Management, AFSL 526798. The information contained in this podcast by me, my colleague Matt Rigby, or any of our guests may include general advice and does not consider your personal circumstances. You should seek personal advice from a registered financial advisor who can consider whether the general advice is right for you.